The most expensive decision in this video takes about 11 minutes on the telephone. It is not a mistake. It is not a scam. It is the sensible thing, the obvious thing, the thing the person on the other end of the line will tell you is correct, and the thing almost every financial professional in the country would sign off on without blinking. And for a certain kind of person holding a certain kind of account, that 11-minute phone call quietly costs more than a house fire. I want you to sit with how strange that is, because it is the reason this video exists. Most of what goes wrong with money in retirement is a slow leak, a fee you did not notice, an account earning nothing, a rate that dropped while you were not looking. Those are bad, and they are also forgiving. You can find a slow leak in year 4 and fix it in year 5, and most of what you lost comes back over time. The 3 things I'm going to show you today are not leaks. They are doors, and they open in one direction only. Each one has a specific moment. A form gets signed, a box gets checked, a phone call ends, and on one side of that moment you have every option available to you, and on the other side of it you have one option, permanently, for the rest of your life and the rest of your families. And here is the part that makes them so dangerous. Not one of those 3 moments feels like anything at all. There is no warning screen. Nobody says, "Are you sure?" The person helping you does not know either, because the thing you just gave up was never on their form in the first place. That is the entire pattern. Not the government coming after you, not a new law. 3 ordinary, reasonable, recommended decisions, each of which closes a door behind you that most people never knew was open. My name is Kevin. I read the rules so you do not have to. If you are new here, this channel exists for one reason: to get to you before the moment, instead of explaining the moment afterward. Subscribe and turn on the bell because the first of these 3 is sitting in the retirement account of a very specific kind of American worker. And if that describes you, this may be the most valuable 20 minutes you spend this month. One honest thing before I start. You almost certainly do not have all 3 of these. Most people have 1. Some of you have none, and you are going to watch this for somebody else, and that is genuinely the best reason to be here. And I am not going to tell you the government built these traps to catch you. That is not what this is. 2 of the 3 things I am about to describe are actually tax breaks. They are provisions written to help you. The danger is not that they exist. The danger is that they have to be claimed, and if you do not claim them at the exact moment they are available, they are simply gone, and nobody in the process is required to mention them. Let me start with the biggest one. Asset number 1 is company stock sitting inside a retirement plan at a job you already left. If you spent a career at a utility, a phone company, a manufacturer, a grocery chain, a railroad, a bank, an insurance company, anywhere that puts shares of its own stock into your retirement plan year after year, this section is for you. And I want to be specific about who this is, because it is not who people assume. This is not a wealthy person's problem. The person most exposed to this is somebody who worked at one company for 25 or 30 years, took the company match in company stock because that was simply how the plan worked, never thought about it, and now has a retirement statement with a large number on it and no idea there is a special rule attached to part of that number. Here is the rule. When your own money grows inside a traditional retirement plan, every dollar of it eventually comes out as ordinary income, taxed at the same rates as a paycheck. Everybody knows that part, or at least everybody who watches this channel does. But there is an exception carved into the tax code for one thing and one thing only: company stock. Shares of the employer itself held inside that employer's plan. The growth on those shares, the difference between what the plan originally paid for them and what they are worth now, has a name. It is called net unrealized appreciation. And under the rule, that growth can be taxed at long-term capital gains rates instead of ordinary income rates. Now let me put that in plain numbers because that sentence does not land until you see it. Ordinary income rates for most retired households run around 12 or 22% federal. Long-term capital gains rates for those same households are frequently 0 or 15%. So take a person with $150,000 of growth sitting in company stock inside their old plan. Under ordinary income treatment, at 22%, that growth carries a tax bill of $33,000. Under capital gains treatment, at 15%, it carries a bill of $22,500. And for a household with modest enough income, part of it can land in the 0% bracket and carry no federal tax at all. Same shares, same person, same money. A difference of 10,000, 20,000, sometimes far more, depending entirely on how the money leaves the plan. And here is the door. That election exists at exactly one moment, the moment the money comes out of the plan. If you roll the whole balance into a retirement account, the way virtually everyone does, the way you will be advised to do, the way the paperwork is designed to make easy, the election is gone. Not delayed, not harder. Gone, permanently, and there is no form to undo it. Let me tell you about Wendell. Wendell is 67. He lives outside Terre Haute, Indiana. He spent 29 years at a utility, mostly on the maintenance side, and for most of those years, a portion of what went into his retirement plan went in as shares of the company. He never chose that. It was simply the default. He looked at the statement twice a year, saw the number going up, and got on with his life. When he retired, he did what everybody does. He called the plan. He said he was leaving and he wanted to move his retirement account somewhere he could manage it. The person on the phone was pleasant and efficient and walked him through it, and about 11 minutes later, the entire balance was on its way into one rollover account, which is the standard, normal, recommended outcome of that phone call. Nobody said the word stock. Nobody asked whether any of the balance was in company shares. Nobody mentioned that a portion of that account had a one-time election attached to it, worth more than his truck. He found out 14 months later from a man at church who had retired from the same utility 2 years earlier and had a son-in-law who happened to know the rule. The two of them were standing by a folding table at a potluck. The other man asked, casually, the way you ask about the weather, whether Wendell had taken care of the stock piece before he rolled. And Wendell said, "What stock piece?" And when Wendell called back to ask if it could be reversed, the answer was no. Not no with paperwork, not no with a penalty, just no. The shares had been sold inside the plan, and the proceeds had gone into a retirement account. And at that moment, the only asset in the tax code with that particular exception attached to it stopped existing. The plan had done nothing improper. The representative had done exactly what she was trained to do, correctly and courteously, in about 11 minutes. She processed a rollover, which is the single most common transaction in American retirement, and the overwhelming majority of the time, it is the right transaction. And I want to be fair to her because I think this is where people get angry at the wrong target. She was not hiding anything. She almost certainly did not know either. That rule is not on her screen. It is not part of the script she reads. There is no field in the system that flashes when a balance contains employer securities and asks whether the caller understands what they are about to give up. The failure was not a person. That is what makes it so hard to be angry about, and so easy to repeat. Now I want to stop right here because Wendell is exactly the person I built this thing for, and I want to be honest about why. He did not need a financial expert. He needed one question asked out loud before 11 minutes on the telephone. Is any part of this balance in company stock? That is it. That is the whole difference between his story and no story at all. And there is nobody in this country whose job it is to ask him that. That is what the Quiet Rules is. It is the questions written down in plain English in the order you need them, so that the person sitting at a kitchen table with a phone and a statement knows what to ask before the call, instead of learning it at church 14 months later. You can find it at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee, always. If it does not hand you something you did not have before, you send it back, and that is the end of it. Because the alternative is a man at a church potluck finding out what a phone call cost him from somebody who happened to know. Now let me give you the rest of this rule, because it has sharp edges, and I do not want anybody watching this to go call their plan tomorrow and make it worse. This is not a strategy you should run because a video told you to. It is a question you should ask before a door closes. Those are different things, and the difference matters. Here is how the election actually works when it is done correctly. The shares have to come out of the plan as shares, actual stock, moved into a regular brokerage account, not sold inside the plan and sent out as cash. If the plan sells them, it is over. The whole thing depends on the shares themselves walking out the door. In the year you do it, you pay ordinary income tax on the original cost, not on the current value, on what the plan paid for those shares back whenever it bought them, which for a long career is often a small fraction of what they are worth today. And then the growth, all of it, sits in your brokerage account waiting. When you sell, it is taxed at long-term capital gains rates, automatically long-term by the way, regardless of how long you have actually held them. That is written into the rule. There are conditions, and they are strict, and this is where people blow it up. It has to be a full distribution. The entire balance of the plan has to come out inside a single calendar year. If you leave a small amount behind, or if you took a partial rollover first, the election can fail for the whole thing. There has to be a qualifying event: leaving the job, reaching a certain age, disability, or death. You cannot simply decide one Tuesday that you would like to do this, and it has to be all plans of that type with that employer. If you forgot about a small profit-sharing balance from 1991, that forgotten balance can disqualify the entire election. Now, the honest part, and I am going to be blunt because I would rather lose your click than mislead you. This is not always the right move. Sometimes the ordinary rollover is genuinely better, and here is when. If the plan's original cost in those shares is high relative to what they are worth now, the advantage shrinks and can disappear entirely. If you do not plan to sell for a very long time, the tax deferral inside a retirement account can be worth more than the rate difference. And the election leaves you holding a concentrated pile of one company's stock, which is a real risk that has nothing to do with taxes and has wiped out plenty of retirements on its own. There is one more thing that almost nobody mentions, and your family should know it. That built-up growth does not get the reset in value that most assets get when somebody dies. Whoever inherits those shares inherits the tax on that growth along with them. So this is not a video telling you to elect. It is a video telling you to ask. Here is what to actually do, and it costs nothing. Pull the most recent statement for every retirement plan you have at every company you no longer work for. Look for a line that says company stock, employer securities, or the name of the company itself listed as a holding. If you see one, that plan has this attached to it. Then call the plan administrator and ask 2 questions. What is the current market value of the company stock in my account? And what is the plan's recorded cost basis for those shares? Write both numbers down. That is it. That is the entire homework. Because if the gap between those 2 numbers is large, you are holding a one-time election worth real money, and the moment you roll that account is the moment it disappears. Ask the question before the call, not after it. And if you have already rolled it over, I am sorry, and I want you to hear this clearly so you do not spend a week trying to fix something that cannot be fixed. That door is closed. But you almost certainly know somebody who has not made that call yet, and this section of the video was built to be sent to them. Now, asset number 2, and this one is in a house, not an account. Physical gold, silver, coins, and collections. A lot of you have this, not in a vault, not as an investment portfolio, in a closet, in a safe in the basement, in a coffee can. Honestly, I have heard that more than once. Bought during a scary stretch in the 70s or the early 80s, or after the crash in 2008, when it felt like paper money might not hold. And most people who hold this believe 2 things about it that are wrong. The first wrong belief is that it is taxed like a stock. It is not. Under the tax code, physical gold, silver, platinum, and palladium are classified as collectibles, same category as art, antiques, and rare coins. And long-term gains on collectibles carry a maximum federal rate of 28% instead of the 15 or 20% that applies to stocks. Now, I want to be precise here because a lot of videos get this wrong and scare people unnecessarily. 28% is a ceiling, not a flat rate. If your ordinary rate is lower than 28%, you pay your rate. For a retired household in the 12% bracket, gold gains are taxed at 12%, not 28%. But notice what that actually means, because it is worse than it sounds for exactly the people watching this. With stocks, a modest income household can land in the 0% capital gains bracket and pay nothing at all. That 0% bracket does not exist for collectibles. There is no preferential rate. Your gold gain is taxed at your ordinary rate no matter how low your income is. So the person who benefits least from this rule is the retiree living on a modest income. The wealthy person with a very high income actually gets a ceiling. You get nothing. The second wrong belief is the more expensive one, and it is the reason this asset is on my list at all. Most people believe that if the dealer does not file a form, the sale is invisible. That is not true, and it is not even the important part. The important part is what happens when you cannot prove what you paid. Your tax is calculated on the gain, sale price minus what it cost you, which means what it cost you is the single most valuable piece of paper in this entire section, and almost nobody has it. If you cannot document what you paid, you are in a position where the burden of proving that number is on you, not on the government, on you. And a sale of $40,000 worth of coins with no records behind it can be treated very differently from a sale of $40,000 worth of coins with a receipt showing you paid $31,000 for them. Think about what that means for the specific way this asset gets bought in this country. Nobody buys a coin the way they buy a mutual fund. There is no monthly statement, there is no annual summary that arrives in January with a cost figure printed on it. There is a man at a counter, and a handshake, and sometimes cash, and a small paper receipt that goes into a wallet, and then into a drawer, and then, at some point in the following 4 decades, into a trash bag during a move. The entire asset class is built on paper that nobody was ever told to keep. Compare that to a stock. If you bought shares in 1990, and your brokerage has changed hands 3 times since, somebody somewhere still has a record of what you paid, and there are rules requiring it to follow the account. Your cost travels with the asset automatically. You could forget about it entirely for 30 years, and the number would still be waiting for you. A coin carries no memory at all. It is worth exactly what it is worth today, and the story of what you paid for it exists in one place only, which is whatever you personally wrote down. And here's the second thing about this asset that makes it different from everything else on this channel. Almost every other trap I cover has a moment where a form arrives, a notice, a determination letter, something in an envelope that tells you the machinery has noticed you. This one has no envelope. You sell the coins, you get a check, the money is good, and 11 months later, somebody asks you a question you have no way to answer about a purchase made during the Carter administration. Let me tell you about Opal. Opal is 79. She lives in a small town in southern Missouri. Her husband bought silver and gold coins for about 15 years, starting in the late 70s, a little at a time, from a dealer 2 towns over and sometimes at shows. He kept them in a floor safe. He knew exactly what he had paid for every one of them because he was that kind of man, and he kept it all in his head and in a spiral notebook. He died in 2019. The notebook was not in the safe. Nobody has ever found it. Last year, Opal needed a significant amount of money for a medical situation involving her daughter, and she took the coins to a dealer and sold most of them. The money was real and it helped, and I want to say clearly that she does not regret it. But when it came time to file, nobody could establish what her husband had paid. And that mattered enormously, because with no documented cost, the assumption pushes toward a much larger gain than the family actually experienced. And there was a second layer she did not know about, which is the part that genuinely made me angry when I looked into it. Because those coins passed to her when her husband died, their value for tax purposes should generally have been reset to what they were worth on the date of his death, not what he paid in 1981. That reset is real, it is written into the code, and for a widow selling inherited metals, it can be the difference between a large gain and almost none at all. She did not know that either. Nobody told her. The dealer's job is to buy the coins, not to explain the tax code to the woman selling them. So the coins were sold correctly, at a fair price, by an honest dealer, and the paperwork around them was a decade of missing information. Now here is what I want you to take from Opal, and it is why I keep making this channel. The problem in her house was never the coins. It was a spiral notebook nobody could find. That is the whole thing. And the same is true for a shoebox of medical receipts and a divorce decree and a bond issue date and a plan statement showing a cost basis. That is what the quiet rules is for. It is the paper version. What to write down, where to keep it, and what somebody in your family needs to be able to find in the week after you are not there to explain it. Written large, written plain, meant to sit in a drawer and be found. Same place, Kevin Explains, .shop, link in the description, pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no argument, no questions. Because the alternative is a 79-year-old woman being asked to prove a number that a man wrote down in a notebook nobody has seen since 2019. Now let me give you the actions on this one, and this is the section to write down. First, if you hold physical metals or a collection of any real value, find whatever record exists of what was paid this week while you are thinking about it. Receipts, canceled checks, bank records, the dealer's name, anything. If there is nothing at all, sit down and write out what you do know. When it was bought, roughly, from whom, at what kind of price. A written contemporaneous record is worth vastly more than nothing. Second, if you inherited metals or a collection from a spouse or a parent, find out what it was worth on the date that person died, because that is very likely your starting value, not what they paid. If that death was recent enough that a value can still be established, get an appraisal in writing now. That single piece of paper can be worth more than any investment decision you make this year. Third, if you are planning to sell a large amount, do not sell it all in one afternoon. Same principle as everything else on this channel. Income that lands in 1 year hits harder than the same income spread across 2. And fourth, a small one that matters. Tell somebody in your family where the records are, not what you own, where the paper is. Those are different pieces of information, and only one of them is useful later. I want to add one more thing here because it comes up every time I discuss this, and it deserves a straight answer. A lot of people hold metals specifically because they do not trust the system, and they like that it sits outside of it. I understand that entirely, and I am not here to argue with anyone about it. But I want to point out something that I think gets missed. The reason to keep records is not because somebody is coming to check. The reason to keep records is that without them, you are the one who loses. The number you cannot prove is not a number that gets rounded in your favor. Every gap in the paper trail costs the person holding the metal, not anyone else. So if you hold this because you do not trust institutions, the documentation is not a concession to them. It is the only thing standing between your family and a number somebody else gets to assume. Now, asset number 3. And this is the one with an actual clock on it, and it is the cruelest deadline in the American tax code, and I do not think that is an exaggeration. The family home after a spouse dies. Here is the background, and I will keep it short. When you sell your main home at a profit, you can exclude a chunk of that profit from tax entirely. For a single person, $250,000 of gain. For a married couple filing jointly, $500,000. Those numbers were written into law in 1997. They have never been adjusted for inflation. Not once, in almost 30 years. Which means a house bought in 1982 in a town that did well has quietly grown past the line while the line stood still, and a great many ordinary people who never thought of themselves as having a taxable anything are now sitting on a gain larger than the exclusion. That part is well known enough. Here is the part that is not. When one spouse dies, the survivor becomes a single filer, and a single filer gets $250,000, not $500,000. But the code contains a mercy provision. A surviving spouse can still claim the full $500,000 exclusion if the sale closes within 2 years of the date of death, and if they have not remarried, and if the couple would have qualified before the death. 2 years from the date of death, not 2 tax years. 24 months from the actual day. Sell in month 23, and you have $500,000 of gain protected. Sell in month 25, and half of that protection is gone. Same house, same buyer, same price, and the calendar took $250,000 of shelter away in the space of 8 weeks. Now think about who this rule lands on. It lands on somebody in the 2 years after their husband or wife died. That is precisely the stretch of time when nobody is thinking clearly, when everyone around them is saying do not make any big decisions for a year, and when the paperwork of a death is already consuming every ounce of energy they have. The most expensive deadline in this video is a deadline that runs entirely inside the worst 2 years of a person's life, and nobody sends a letter about it. Let me tell you about Lorene. Lorene is 74. She and her husband bought their house in 1979 in a Denver suburb for a number that would not buy a car today. They raised 3 children in it. He died in the spring, 4 years ago now. She stayed. Of course she stayed. Everyone told her not to make a big decision in the first year, which is genuinely good advice about almost everything, and which happened to be catastrophically expensive about this one specific thing. By the 3rd year, the stairs were becoming a real problem, and her daughter in Colorado Springs wanted her closer. So she sold and moved, and the sale went smoothly, and the number on the closing statement was very large, because Denver did what Denver did. She had passed month 24 by about 10 months. Her exclusion was $250,000 instead of $500,000. And she paid capital gains tax on $250,000 of gain that would have been fully protected if the same sale had closed the previous summer. Nobody involved did anything wrong. The realtor's job is to sell the house. The title company's job is to close it. Her children were focused on getting her somewhere safe. And there is no agency, no form, and no letter in this country that tells a widow her clock is running. And I want to be careful here because there is a second half to this that works in her favor, and it is important. When a spouse dies, their share of the home generally gets its value reset to what the house was worth on the date of death. In some states, both halves reset. That reset can wipe out most of the gain on its own, and for a lot of households it means there is no tax problem at all, regardless of the 2-year window. So please do not watch this and panic. For many of you, the reset alone solves it. But which of those two situations you are in depends on how the house was titled and what state you live in, and that is not something you should be guessing about in month 22. Here is what to do, and it is short. If you have lost a spouse in the last 2 years and you own a home you might ever sell, find out this month what your gain would actually be. Not roughly. Get the date of death value, get the purchase price, get the record of every improvement you ever made to that house, because improvements raise your cost and lower the gain, and almost nobody keeps those receipts. And if the answer is that your gain is comfortably under $250,000, then wonderful. This section does not apply to you, and you can move when you are ready. But you should know that on purpose from a number instead of finding it out at a closing table. If you have not lost a spouse, then do the version of this that takes an hour. Find out what you paid for your house. Find out what it is worth. Start a folder for improvement receipts today, going forward, even if you have nothing from the past. Because the exclusion has not moved since 1997, and it is not going to, and the gap between the line and reality gets wider every year you stay. And let me spend one more minute on that improvement folder, because it is the most boring thing in this video, and it is quietly worth thousands of dollars. What you paid for the house is not actually your cost for tax purposes. Your cost is what you paid, plus every permanent improvement you ever made to it. The roof, the addition, the new furnace, the kitchen, the finished basement, the driveway you replaced in 2004. Every one of those raises your cost, and every dollar of cost is a dollar of gain that never existed. 40 years in a house is a lot of roofs. For most families, that number is not small, and for a lot of them, it is enough to move the entire question of whether there is any tax at all. And almost nobody has the receipts, because who keeps a furnace invoice for 19 years? So the number gets estimated downward, or left out entirely, and the gain on paper ends up larger than the gain in real life. Repairs do not count, by the way, and that trips people up. Fixing a leak is not an improvement. Replacing the roof is. The line is roughly whether it added value or extended the life of the house, versus simply keeping it running. So the folder is the entire strategy. A shoebox, a manila envelope, a drawer, it does not matter. Every time somebody does permanent work on your house, the invoice goes in it. That is a 5-second habit that becomes a real number at exactly the moment a real number matters. Now let me give you my honest opinion, and it is only that, and you are welcome to tell me I am wrong in the comments. I do not think any of these 3 rules is unfair. I want to say that clearly because it would be easy and popular for me to stand here and tell you the system is rigged. The company stock rule is a genuine tax break. The reset in value at death is a genuine tax break. The $500,000 exclusion is a genuine tax break. And the 2-year window for a widow exists specifically so nobody is forced to sell a house in the month after a funeral. Every one of these was written to help somebody. What I object to is something narrower and I think more damaging. It is that every single one of them has to be claimed, and not one institution in the chain has any obligation to tell you it exists. The plan administrator on the phone is not required to ask about company stock. The coin dealer is not required to mention what a date of death value is. The realtor is not required to know what month you are in relative to a death that happened 2 years ago. And all of those people are behaving correctly. That is not their job. Nobody has assigned it to anyone. So we have built a system where the benefits are real, and the benefits are conditional, and the condition is that you already knew about them, which means the entire structure quietly sorts people by who happen to have a well-informed friend. Wendell had a man at church 14 months too late. Some people have a son-in-law who knows the rule, and they keep $20,000. That is the actual dividing line. Not income, not intelligence, not care. Proximity to somebody who happened to know. I do not think that was designed on purpose. I think it is what happens when nobody is responsible for telling you anything, and it is the whole reason this channel exists. All right, here is your checklist. 3 things, none of them requiring a professional to start. 1. If you have a retirement plan at a company you no longer work for, look at the statement and find out whether any of it is in company stock. If it is, Call and ask for two numbers, the current value and the plan's cost basis. Do that before you roll anything anywhere. 2. If you hold physical metals or a collection, find the records of what was paid this week, and if you inherited them, find out what they were worth on the date the person died. Write down where that paper lives and tell one other person. 3. If you have lost a spouse in the last 2 years and own a home, find out today where you are in that 24-month window and what your actual gain would be. If you have not lost a spouse, start the improvement receipt folder anyway. Let me leave you with the thing I most want you to keep. Wendell made a phone call that every professional in the country would have told him was correct. Opal sold coins at a fair price to an honest dealer. Lorene took the best advice anyone gives a grieving person, which is do not make a big decision in the first year. Not one of them was careless. Not one of them was greedy. Every single one of them did the sensible thing, and the sensible thing was the expensive thing, because a door had been standing open that nobody had ever mentioned to them. That is what I want you to take from this. In these three situations, the reasonable choice and the right choice are not the same choice, and the only thing that separates them is one question, asked out loud before the moment instead of after it. So go ask it this week, while every one of these is still yours to decide. Pull one statement, open one safe, look at one calendar. The door is not going to knock before it closes. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.